I'm Chris Preston.
And I'm not Brad Simmerman, Tyler London here this week.
And this is Street Check, the best podcast in the history of Cabot Wealth Network, although Tyler may put that to the test today. Um, yes, as you can see, if you're watching on YouTube, Tyler London, our resident um, small cap expert and early opportunities investing advisor, is joining me today in Brad's stead. Brad is celebrating his, do we know what birthday this is? I think he's past 40, like 41, 42-ish, something
Yeah,
like
let's
that.
go with mid 40s, just to
Yeah. Well, yeah. Well, he's not here. We could call him 50 if we want. He is, I believe he's in Chicago for the weekend. So hopefully he's enjoying uh, a birthday without being in this chair talking to me. Tyler, I forced you to take his place, and we're gonna scrap our usual format. No defend the take today. No big three. We're gonna go, sort of around the horn. Hit a lot of topics. Tyler, as I mentioned, small caps are your wheelhouse, which we're going to get to. But you're also good at the macro stuff and sort of high level market and Fed inflation stuff. So let's start with that. Obviously Brad and I have talked ad nauseum about the Fed and inflation, and people are probably tired of hearing from us about it. What's your take? So I think we left off last week, Brad saying he thought there'd be one rate cut before the end of the year. I think it'll be two. We pretty early on in the year were like, it's not going to be six. And, I think we were in the 2 to 3 camp. And that's looking, I mean, three feels optimistic at this point. What do you think?
um, I think that two is optimistic. I think it's one or none. And
Really?
I'm
None. Wow.
totally, yeah, maybe that's the hot take, right?
That's
None
a
at
good,
all.
that's your defend the take. Let's defend it.
I think, as to your point, like it has been, none of us wanted to be Fed watchers here at Cabot that I'm
Right.
aware of, right? Like it has been super annoying that we have had to pay so close attention. But obviously interest rates are near like 15, 20-year highs, and it has such a dramatic impact on the market and how everybody invests that we have been forced to pay super close attention. And next week on that webinar, I'll have a chart of small caps versus the 10-year interest rate and like the inverse correlation, and it's clear as day. Um, but I think, just back to your setup there, I think that every like little bit of data comes out, expectations for rate cuts change, right? So a month ago, maybe we're going to get one, maybe we're going to get two, and then we get the CPI and PPI data, and then expectations, like probabilities, jumps to over 50% for a September cut. Uh, and now they're back under that after this week's data. So it continues to move around. And for those of us that are following it pretty closely, like the market reacts almost instantaneously to these changes in expectations. And so
Yeah.
it is interesting to watch, a little bit frustrating because obviously we have no control over it. So your stocks are kind of moving around based on these macro things.
Right. Yeah. I mean, I think if it's even one before the end of the year, I think that'll have almost a negligible, because that's the market is really just wants to see one. Like I feel like that'll
Yeah.
have almost a negligible. People are anticipating one, and once they see one, it'll be more relief than anything. It might already be priced in. I think shy of one could cause a little bit of panic, maybe, especially if like September seems to be the month that people have landed on. But then again, they landed on March originally, and then May, and that kept getting pushed back.
Yeah.
But I wonder if past the election, because there's no October uh, Fed meeting. I wonder if past the election would freak people out a little bit. I think that's why people are anticipating September. Um, but yeah, if you're right, I wonder if that might be a thing that sends a little bit more panic into the market than we've seen, certainly.
Yeah. I think like that November expectation is going to just would just be so weird, right? Like if we have a presidential election and then like a couple of days later we get a rate
Yeah,
cut, the
yeah,
optics on that are weird. I think the messaging, so long as, just referencing your point about the market like freaking out and investors getting concerned, so long as the messaging is more toward the side of we're at the peak for the cycle, we're not going to hike, rate cuts are coming, like if that carrot is still dangling, whether it's
Right.
December or the beginning of next year, I think that to me is the most important thing.
Yeah.
But that all kind of assumes that there's no crazy change in trend in the economic data, like consumers just shutting down and GDP falling and all that messiness that goes with early stage recessionary type signals.
Right. And with that, I think you may have written about this initially, and I sort of latched onto it. We talked about it here on the podcast a few times. The 10-year yield being, it seems like 4.5% is kind of the line of demarcation. Anything below that, stocks seem to act well. Anything above that, stocks like in April take a dip. Um, is there a level that you like to see? I mean, do you agree 4.5% is around it, or do you think it's more of a when rates are or when yields are falling is good for stocks regardless of where they are? I mean, I guess south of 5%, clearly five when it got close to 5%, that was bad for the market. Was it last October? Was it around
Yeah.
then?
Yep.
No, the
Exactly the
market
month.
bottom. Is there a level you sort of look to with the yields?
Well, just looking at the chart, which I pulled up in front of me while you were talking, I think that 4.7% area is like where the 10-year yield dropped below back in early November. And
Hmm.
that kind of kick-started like a nice leg up in the market.
Yeah,
And it went back up to that level, 4.7% in late,
late
um,
April.
yeah, in late April.
Yeah.
And things were definitely getting funky then. Like there was a lot of sort of odd stock movement on an individual stock level. So I think 4.7, if we go above that, that becomes a problem. This area of like 4.5 to 4.7, I think is definitely getting concerning. Um, so, but like 4.3 to 4.5, I mean, that to me seems like a pretty good zone. Because that implies obviously a decent cut or two from the Fed.
Yeah, and if you really, I mean, I'd sort of contended that if you really want to just strip out the noise of Fed inflation, geopolitical stuff, everything, if you just look at that, at the 10-year yields, a pretty good gauge of where the market's going to be. Like
Yeah,
you said, 4.7 and above, bad for the market. And it's been all since May 2nd was the last time closed above 4.5%, and it's been a good month for stocks. So it seems like you just look, if you really want to simplify things, just look at that chart and it'll tell you where stocks are headed, or where they're trending at least.
yeah, I completely agree. I look at it every day, and it just kind of, as you said, it pulls everything together and gives you like a pretty easy indicator on a nice clean line on your screen of kind
Yeah.
of why things are happening. Yeah.
Yeah. Okay, let's get to the big event this week was Nvidia reporting earnings. Blew it out of the water again. I don't have the numbers in front of me, but Nvidia stock jumped from around 950 to it's like 1,044 as we record this. Um, and now they're going to do a 10 for one stock split, or planning to do a 10 for one stock split. Um, what was your takeaway? I mean, clearly, there was some angst going into the event that a weaker than expected Nvidia earnings could, send markets back to where they were in April, which didn't happen. But stocks also haven't exploded on, Nvidia's. The stock that exploded was Nvidia, but the rest of the market not so much.
Right. Yeah. It was an interesting day, right? Like market opened up nicely. NASDAQ was up,
Right.
Nvidia was soaring, and then throughout the day things kind of fell apart. And actually the 10-year yield jumped up and the VIX kind of spiked a little bit, that being relative because it's still pretty low. But I think so so I listened to the Nvidia conference call, and anybody that has like an hour or 45 minutes should definitely pull that up and listen to it, because I think that kind of helps explain what is going on in like the computing world and helps put things in context, and why you see a huge company like, or a large company like Nvidia just moving so much, and why that stock has done so well. And you tie that into what we're hearing from Google and um, Microsoft and Facebook and all these big mega cap companies that are making significant investments in infrastructure again. And there's just so much there from the Nvidia conference call. And I pulled out a couple quotes from the CEO, Jensen Huang. If I pronounced his last name right, if I did it wrong, I
We've
apologize.
yeah, we've tried. That's what we've gone with in the past. Yeah.
Okay. Um, so he says, and he just, what was interesting about the call is a lot of times like analysts ask questions and management gives an answer. And on this one, he just like goes off and he's just talking, at length about like big picture stuff, about how we're completely redesigning how computers work, about how this is a platform shift and it's more profound than previous shifts, and how computers are moving from no longer being like an instruction driven thing where we put in what we want and the computer reacts, but understanding our intentions as users, understanding how we interact with them, what we want them to do, and then doing it for us. So the computers of like the not too distant future, they have the ability to reason and come back with a plan and get a solution. And it kind of in a way is like if you go back, 20 or 30 years to when Microsoft and Apple and IBM, they were all, redesigning operating systems and how users interact with computers. It almost sounds as though this is another like major platform shift. And I think that is kind of the exciting thing to me and why Nvidia stock is moving so much because um, big companies need the infrastructure in order for the systems to work properly. And it's not just data centers. Of course, those are hugely important, and there's like this race to build data centers, but also on personal computers themselves and our phones and our um, iPads and whatever. And so Apple's going to be talking about putting AI chips and programs that can allow these more powerful operating systems to work on the phone, not just when it's connected to the internet. And Microsoft has just done that with its Copilot and new PC release. So I know I'm kind of getting into the weeds of it a little bit, but like when you listen to what they're talking about, it's a much bigger shift, I guess, than just hey, Nvidia is like really doing well because they have these chips. It's really setting the stage and the infrastructure for this next platform shift generation of computing and how we will all use these devices. And I think there's, obviously there's been a lot of really standout performance from Nvidia and other chip stocks, but it definitely gets your imagination going in terms of where some of these companies could go.
Yeah, I mean, it's the revolutionary, game-changing aspect is what, was what's made it such a, the biggest star in the market right now. And, I'm looking at I pulled up the raw numbers from the report, $6.12 earnings per share for Q1. That was up 628% from a year ago, and $26 billion in sales, up 268% from a year ago. So that's pretty healthy growth. I mean, yeah, you could say it's kind of like, you know, it's it's Apple when it was rolling out, the iPhone. Maybe a little less mainstream, at least right now, than that, but it's that kind of growth and excitement. It's sort of, I mean, it's part of the, Magnificent Seven, but it is the least mature of the Magnificent Seven in a good way. Like it's at the earliest stage of its growth, which is why there's all this excitement, right?
Yeah.
Um,
Um,
yeah, sorry, go ahead.
no, I was just going to say you were running through those numbers of like those growth numbers. One of the other things that they said on the call was that their customers, like for the data centers, I think for like every dollar that they're spending on Nvidia infrastructure, they're getting like a 5 or 7 times return over, I think it's like 4 years. So, I mean, that's why everybody wants this stuff, right? It's like making things more efficient and they're making a lot more money on it.
Right. And you mentioned, sort of revolutionizing tech infrastructure, and that's been a hot segment now. Then other tech segments have not been as in favor with investors of late. Namely, you mentioned prior to this, software has been slumping, and I know software is sort of in your wheelhouse in your two newsletters, Cabot Small Cap Confidential and Cabot Early Opportunities. Why do you think software is, sort of lagging behind at the moment?
Yeah, I think well, and you probably as well. Like I don't know if in Habit Stock of the Week, if you have many software companies.
No, not much right now. Yeah, I probably did maybe at the beginning of the rally in November. I may have had a little bit more software related plays,
Yeah.
but not as much now. Yeah.
Well, so remember like 5, 6, 10 years ago, there was obviously cloud software
Yeah.
was like the thing. There was this movement to the cloud, and all of these software platforms allowed people to work from wherever and share resources and all of that. And I think um, now what's happening, and we have had a lot of software companies over the years, both small, mid, and large caps. Um, but and a lot of them really did well during the pandemic. But now with like this race, I guess you could call it, to invest in the infrastructure, a lot of these software companies, it seems like, and this is probably an overgeneralization, but like they have to tweak their software to run on to run AI and to um, a little bit hard to articulate, I think, but to kind of adapt to the way users are expecting to work with and interact with these new generations of computers and AI and large language models and all of that stuff. And I think that there are some software companies or companies that have software like Microsoft that are they're integrated with AI and this next generation of technology that are doing it really well. And then you have a lot of other companies that are kind of playing catch up or maybe are sort of becoming irrelevant because the software, the like AI and new programming can do that work for the users where you don't need
Mhm.
to use the software. So I think there's a decent amount of disruption. And again, I'm definitely over generalizing. A lot of this is happening on a company specific basis. But if you look at like the um the two main like cloud software ETFs, CLOU is a ticker symbol for one, and WCLD, they are not doing that great. And those have done well at times. I think interest rates play a part, but just comparing them to some of the semiconductor ETFs like SOX, SOXX, and SMH, it's just clear as day that there's way more demand for companies and stocks that are in the semiconductor space than in the cloud software space. So it's like infrastructure is winning out over software at the moment. And again,
Yeah.
that is a generalization, right? But
Oh, but to your point, yeah, I just pulled up a chart for WCLD, one of the ETFs you mentioned, down 8% year to date, which is, stark contrast to the market. And in the last year, it's up less than 12%. So yeah, not exactly exciting growth. It's certainly not this year.
yeah. And a lot of these point like really specific software companies like I just pulled up Sprout Social, SPT. I mean, that was a hot stock that we owned for a while. It did really well. The
Hmm.
thing has been crushed. HubSpot is doing better, but not really doing that much. I mean, you could run through all kinds of examples, but I think you would just find that a lot of the small and mid cap companies, software companies, are not doing that great.
Yeah. Well, you teed me up perfectly there. I was about to shift to small caps, your bread and butter. Yeah, so small caps have underperformed large caps for, I mean, what is it now? 3 years? Three
Oh
years?
man. Well, let's see. I have a comparison chart going back 5 years, and yeah, I mean over year to date, 1 year, 3 year, 5 years. It's been a while. It's been a
Yeah, and the pattern usually is that small caps, I think you've mentioned this maybe on this podcast, is small caps tend to outperform large caps every 3 out of every 5 years. and that hasn't been the case the last 3 years. So you'd think they're due, but what's been holding them back, you think?
Yeah, I think like a number of things, right? So interest rates for sure
Yep.
has been a bit of a challenge, like we talked about. I also think that this upward pull of the mega caps in the large cap indices is just so strong. There's like no equivalent
Yeah.
in there's no group of 5 or 7 stocks in the small cap index that is even 10% or 20% of the index, and certainly not that is just absolutely crushing it, right?
Right.
So that comparison, it's very, I mean, it's just really, really difficult to get that many that percentage of the small cap index to perform that well. Um, I think also like the small cap index is more heavily tilted toward financials, uh, industrials, materials. Actually, industrials and materials are doing pretty well right now. Um, but the makeup of the index is completely different. And so
Yeah.
I think that um, you, for like somebody like me that is looking at small caps, these sort of generalized statements like small caps typically outperform. You look back in history and there are periods of that, but a lot of us, like, you're an investor right now, you maybe are wanting something in your traditional brokerage account or IRA, and you're like, the small cap index just hasn't held up. So why is now in the next 1, 3, 5 year period, why is it going to do better than the large cap index? Right. And that's, I think, the question that a lot of people probably would have.
Yeah.
Mm.
You mentioned just the drag of the mega caps being a big reason why large caps have outperformed. We've talked a bunch on this podcast about how the influence of the Mag Seven. I mean that was the rally until really till November, this past November. I just pulled up a chart of the Russell 2000, which I know isn't your favorite small cap index, but just for simplicity's sake, pull that up and overlaid it with the equal weight S&P equal weight index, almost identical the last year. Russell 2000 up about 17% in the last year versus 15.5% for the equal weight S&P index. And that equal weight index, that's equal weight to all the large cap stocks. And then the last 2 years, the equal weight's up 10% versus about 9.5% for the Russell. So it's almost like the small caps are the same as all the other 493 large cap stocks that are not the Mag 7. It's just they don't have the influence of the Mag 7, unlike the large cap indexes.
Yeah. And I mean, I guess intuitively that makes sense. And that's a great comparison that you just made. And when
Thank
we
you.
like step back and we like think about the stock market and like these companies, the influence on the world of these Mag 7 companies like Microsoft, Nvidia, Netflix, Google, like we all use them, we all know them. They have such scale that they can generate billions of dollars with like new products and in new markets, and it's just crazy the value creation that's happened there.
Yeah. Yeah. Um, so I mean, is there a catalyst that you think would trigger a small cap rally, or do you think it's just once the Fed starts to cut rates, you'll start to see small caps creep up?
Yeah, I think that um I mean they have been trading like at the index level so inversely to moves in interest rates that there is a lot of floating rate debt in the small cap asset class. So I feel strongly, I mean, I think it's a pretty accurate statement to say that once interest rates starts to actually come down, the Fed is cutting the federal funds rate, that will help the small cap index do better. And it's not like the Fed is going to cut, maybe 2 times this year and 3 times next year, and we're going to go back to a federal funds rate of like 2% or something like that's not really in the cards, right?
No,
Um,
no.
but I think what small caps will need is lower rates and a decent economy, where there's hiring, the types of businesses that constitute the index have a good operating environment that's like stable, and they can plan, they can hire, and et cetera, and they can innovate. And I think there's a lot like wrapped up in all of that. But I think that sort of the approach that we take in small cap investor, and it's almost like we're saying like stay out of small caps altogether because they just haven't been performing. Of course, there's in the Russell 2000 stocks, right? And in the S&P 600, there's 600. Is we're just looking for those companies that are doing something new or better or faster or whatever than the competition. And there are a lot of those companies. Um, and with investor risk appetite having come back pretty significantly over the last 6 to 12 months, a lot of
Yeah.
the really small companies have been moving, but it's really like specific markets that they play in that you have to pay attention to. Not they're not like these large diversified companies.
Right. Yeah. Do you know generally off the top of your head what small cap growth was this past earnings season? I know large cap it was like a little over 5%, which is pretty good. I imagine small caps got to be growing faster than that, right?
That's a you know what, I should have that answer and I don't.
I don't have it either, so I ambushed you with that. Sorry, but I guess my point is like you mentioned, I think you mentioned something about risk appetite not being there, and it's almost like just the economy is strong enough for small caps to get going, but the narrative is killing it, and a lot of the narrative is rates are still high. They haven't been cut yet. And just the scars of inflation, touching 9% and, 3%, above 3%, still not nothing. Um, and until that sort of narrative fades, maybe that's part of what's uh, limiting people's risk appetite to go buy small caps.
Yeah, I think that plays a part of it, and also momentum, right? It's really hard. Like if you look at the Nasdaq or the S&P 500, it's generally speaking, it's up and to the right,
Yeah.
whereas the Russell 2000 and the S&P 600 have keep topping out at like the same level, and they're not even above their levels from, I guess, what is it, 2021. So you see that. I think that there's some there's some investor sentiment that plays into it, and then also um, just momentum, which
Right.
I think if the S&P 600 can get above this overhead resistance area and kind of break out a little bit, I think that will change things. I think that's going to take, the promise of lower rates a little bit for that to happen. But I think things will get more interesting when that happens, because then the media will start talking about, oh, how cheap small caps are, and they are. Um, and I think there'll be a lot more support for the asset class that your average investor can kind of grasp onto and identify with at the index level. We're all always going to be super interested in the next small company with a
Right.
great product or whatever, right? Because that's always exciting to think and talk about.
Yeah. I mean, I would say, I mean, being, now that I've taken on a value, I recently took on one of our two value newsletters here. In searching for value, I would think this there'd be a lot of value in small caps right now. I haven't really looked at those for my newsletter specifically, but I would think this would be sort of along with China. We had Larry Chung on a few weeks ago, Chinese stock expert. I think there'd be a lot of value in, sort of beaten down slash underperforming markets like China and like small caps in general.
Yeah. Speaking of the value newsletter, do you have much? I haven't looked at it lately. Do you have much like small or even mid cap exposure in there yet?
Closer to mid cap, not so. I've added a couple stocks since I took over. I took over. Bruce Kaiser was my predecessor, really good value guy. Sort of semi-retired to go invest, sort of invest for his family. Good for him. And I took over his Cabot Value Investor newsletter. So far, I've just added. I'm looking for what I've sort of said is, look, I'm not Bruce. I'm not a dyed in the wool value guy. I'm at heart more of a growth guy. So we're looking for growth at value prices. I'm not going to look for half dead, jump just out of bankruptcy companies that technically are a good value because they have a new CEO or something. That's not me. So I've looked for sort of, you kind of take this approach in Cabot Early Opportunities, uh, big companies hiding in plain sight that have, for whatever reason, been overlooked and still have good earnings growth, revenue growth, and yet have become kind of undervalued. I've added a couple, I won't give their names away, but I added a couple, big name companies that everyone knows, in that sort of vein. And that's what I'm continuing to look for. I had a subscriber reach out to me and say, like, what do you think about like alternative energy? Because this has been so beaten down. And I hadn't really thought of that because it's been so beaten down. It's turned sort of a blind eye to it, but that was intriguing to me. So I'm starting to look there a little bit more. We'll see if I find an opportunity. But yeah, I'm looking more growth at value prices because pure value stocks, I mean, for the last decade plus value, it's not been a great time for value. It's been a period of growth. I think Brad had an article this week on the cabotwealth.com website showing that growth stocks have almost doubled value stocks in the last 10 years. And until I'm not going to be one of those, I wrote about this also this week, Dean Wormer in Animal House, complaining about those rapscallion deltas for misbehaving. I feel like value guys sometimes can be like that with growth stocks. Like, no, you can't be that. You can't be valued that high. The market's coming back, and they're wrong usually. I mean, they're eventually right in the same way that a clock is right. A broken clock is right twice a day. But like, I think Tim Lutz, our old boss, used to say trends last longer on Wall Street than anyone anticipates, and that's true of something like a rally in growth stocks, or value stocks being down, or now small caps being down. So I'm going to go with the tide and look for more growthy plays, but that have that have been undervalued.
Yeah. And there's a decent number of like growth and income companies that are raising their dividends because they're doing
Yeah,
quite well. So there's that aspect of it as well.
right. Yeah, exactly. Yeah, I want to say more about it, but I probably shouldn't give it away personally. But yeah, I mean, and if at some point, value stocks overtake the tide shifts and value stocks overtake growth stocks, then maybe I will start leaning into this more pure value, fresh out of bankruptcy stocks. I don't see quite that, but growth is good.
Hey Chris, I have a question for you.
Yeah.
In stock of the week,
Mhm.
which you get to see what everybody is doing
Yeah,
across
like
Cabot.
eight of our newsletters it draws from. Yeah.
Yeah, kind of speaking on this like growth versus value thing. I mean, I know we're more of a growth oriented
Yeah.
company, but any are the trends there with what we are all investing and recommending pretty consistent with what you're kind of saying with
Yeah.
being
Yeah.
growth?
Yeah, it's still more growth. I'm trying to think. I mean, yeah, as we mentioned before, I'm not seeing as much software stuff lately. Just to explain to people what stock of the week I oversee, the other newsletter I oversee is Cabot Stock of the Week, which draws from eight of our other newsletters, one of which is run by Tyler, the Cabot Early Opportunities, and just basically, it's the easiest analyst job here. I get to handpick the best Cabot sort of pre-selected stocks that I see from all those portfolios. And yeah, I've been leaning more growth. I try to make it as diversified as possible, but I try not to force value or even dividends. Um, I think Carl Delfeld, who runs our Cabot Explorer global investing portfolio, he I think so he does both U.S. stocks and overseas stocks. He's been leaning more overseas lately, and maybe that's because U.S. stocks seem overvalued now, or at least were at all-time highs, at least till a few days ago. Um, Retail has been popping up more. I know Mike Santolo has been big on that. I think you too lately. There's been some retail plays that have done pretty well, which is I guess a byproduct of an economy that's held up much better than people thought it was going
Yeah,
to.
there's been a few that have done well, and then some that have done like super poorly as well. It's kind of a
Yeah,
mixed
yeah,
bag.
right. Yeah, it has been a bit of a mixed bag. Yeah, I have. Okay, I'll say I just sold one. I'll just say this one, TripAdvisor, which the premise was, I think this was a Mike pick, not yours, so you're off the hook. The premise was that travel has returned post COVID, which is true. I think we're expecting another record um, spending on flights this year, and so online travel advisor like TripAdvisor seemed like a reasonable play, but it didn't. The stock just didn't. The stock performance wasn't really there, and I don't know exactly what that is versus some others. There's sort of like some cookie cutter restaurant type stock stories that have done quite well. I don't know what the difference is there from a narrative perspective. Maybe it's just a company by company basis, but I guess those are just some of the types of stocks I've been looking at.
Yeah. Well, that's interesting. So, did you pay attention at all to like Airbnb and Expedia because you mentioned Trip? Both of those fell pretty significantly on
Right.
earnings.
Yeah.
Um, and that kind of feeds into this narrative of consumer pulling back on traveling. Of course, then
Yeah.
Delta Airlines they recently hit like a new high.
Right. Yeah. Yeah. I don't know where the difference is there, because clearly people are still, travel is still up. Um, and most people fly to travel. You think the two would go hand in hand. But yeah, I think it's so hard because consumer sentiment did just dip to like almost a 2-year low, I think. That was, to me, that was the more concerning thing for this rally than the will they, won't they Fed thing. That was a little
Yeah.
more pumped. And I guess GDP coming in at only what 1.5% the latest quarter. Those were little more concerning to me than whatever the Fed might do.
Right. Yeah. Like if the Fed is that whole thing is in the backdrop, if then consumers start pulling back,
Right.
not just like there was this discussion of so like 3 or 4 weeks ago, right? Like lower end consumers pulling back, higher end
Hmm.
consumers still doing pretty well. Um, but when you get into, we do tend to have a consumer driven economy, right? Like if consumers really pull back, um, that is concerning. I would agree with you there.
Yeah.
You
Yeah.
mentioned like restaurant stocks. We've been paying some attention to those, and I almost wonder if, and again, this is like a generalization thing, but some of these restaurant brands that have like the healthier food options seem to be doing better than those that don't. And you kind of go down that rabbit hole and you start and thinking about the GLP-1 like weight loss drugs and kind of eating healthier and all that. Is there a connection there? Um, I don't know.
Yeah. Yeah. I mean, yeah, it's funny when those first took off, Eli Lilly and Novo Nordisk in particular took off, well, a year and a half ago, a year ago, certainly. Um, there was, I guess, like, like McDonald's, Pepsi, those kinds of um, retail stocks that were seen as being affected. Coca-Cola, uh, I guess initially took a little bit of a hit, but I never bought that like it was a, you know, direct correlation there. I don't think people are going to stop buying, going to McDonald's or buying Coke and Pepsi or going to restaurants and things like that because of what Wegovy and Ozempic and what's the other Manjaro. That's the Eli Lilly one, right?
You're doing better than I would have done on
Yeah,
those.
and I write about these things every week, which is a give away what might be in my portfolios. But yeah, I never really saw that, but I wonder if now there is some sort of lagging effect that I'd be surprised if it was on travel. But Yeah, I don't know. Yeah, it's hard to
Yeah,
tell.
I don't know if I would agree with that. I don't know if the travel thing plays into that at all. Now, I
Right.
wonder how much of it is investor sentiment driven, right?
Yeah. Yeah.
Mm.
Yeah. I mean, I think there's fatigue over just hearing people hearing the word inflation for 2+ years now and high rates for 2+ years now. I think there's some fatigue that's set in for sure.
When it comes to spending decisions, you mean?
Spending decisions and in the market too. But yeah, I mean, I wonder if that's why we saw the consumer confidence dip as low as we did, or why um, GDP is pulled back,
Hmm.
GDP growth.
Yeah.
Uh,
Well, speaking of consumer confidence, we're heading into a long weekend.
yes, yeah. Speaking of traveling, you traveling anywhere for the weekend?
No, no, no. We're in Rhode Island, and it looks like it's going to be finally a pretty decent weekend. So, it's warm enough, I think, to go out. We have a boat, so
Oh,
we'll go out on the water, even though water's only 60 degrees, so it's a little bit chilly to go in it. But
yeah,
you know,
sailboat.
no, God, no. Nothing against sailing, but two little kids.
Oh yeah, yeah. Nice.
Yeah. How about you?
Yeah,
Are you going anywhere?
we're laying pretty low. We'd entertain uh, going somewhere for the weekend, but like you, we're in May is a big sports after school sports month for our kids. Our kids are about the same age. I don't know if
Yeah.
yours are playing any, but it's been pedal to the metal this month. So we're this is the first weekend we don't have any of that. So we're sort of embracing that. Your kids playing sports right now?
They were playing some stuff at school, not like the town leagues. We kind of did a lot of skiing over the winter, and there was some travel involved in that. So they were pretty excited to do after school activities at school. Um,
Nice.
so
Yeah.
they're like going and jumping in ponds and doing
Okay.
doing crazy stuff like that with their
That's
science
good.
teacher.
Yeah, I've got my son is playing lacrosse and soccer 6 days a week, and
Oh
my
gosh.
daughter is doing gymnastics and lacrosse. Her schedule isn't quite as hectic, but between the two, it's been a lot. Madison, our producer, Madison Robertson, do you have any travel plans? We should acknowledge again Brad's birthday. He's the one traveling, as he should be on his birthday. To test whether he listens to this, do we have any? Should we do like a 30-second roast of Brad while he's out?
We will not say anything bad about Brad. Brad is my best friend, and
Yeah.
we only have good things to say about Brad. So you can
Okay.
give me 30 seconds of the things that you love about Brad. I'll accept that.
You know, I will say that no, I can't do that. I'm glad Brad is having enjoying his birthday, and I'm glad he's getting a break. Yeah, no, I can't do that. Well, Tyler, thanks for filling in for Brad this week. And I think you touched on it earlier, but should give it a proper plug. You have a webinar next Thursday at 2 o'clock, which I'll be on. The title is what's the title?
Uh, I should know. It is about three opportunities to
Yes.
to
Hold on.
make profits
I'll pull it
quickly.
up while you talk. Just say what it's about, and I'll
You
pull it up.
guys,
Yeah,
Opportunity Knocks, three
doing a
asset
great.
classes to profit from now.
Opportunity knocks 3 asset classes to profit from now. Thank you.
Yeah,
You got
thanks,
it.
Madison.
Yeah, just generally, what are you going to be talking about? It's free. It's a free webinar. You can find it on the cabotwealth.com website for people who want to tune in. Yeah,
Yeah, so kind of some of the things that we touched on here, Chris, we'll talk about the current state of the market, talk a little bit about the Fed, but try not to put anybody to sleep on that. Um, have some charts showing forward expectations for rate cuts. I have a bunch of charts and pictures, the performance of the various market indices, what's worked, what hasn't. We'll talk about small caps, talk about some like larger company opportunities that seem pretty obvious. Sometimes that's just in hindsight, but there are some that in the current environment seem pretty intriguing. And then there's one other thing. Oh yeah, we have a market that is kind of coming back to life after being
right.
somewhat dormant, and we'll go not too far down the rabbit hole on that, but it's kind of exciting and it's a fun area to do research and write about, and so we'll talk about that a bit as well.
Yeah, so join us next Thursday, 2 o'clock. Again, it's Opportunity Knocks, 3 asset classes to profit from now. You can find it on the cabotwealth.com website. Here's my 3-second roast of Brad. He's always wrong about the market because he's too bearish and pessimistic. There it is. Okay. I'm glad we talked about the market in a more optimistic way today, Tyler. Brad will be back next week, so we had to get it in now. Thanks again.
Negativity isn't really my thing. Sorry,
That's
listener.
good. It pays. I think the other thing Tim always said was it pays to be an optimist, and it's good to be optimist here. So, Tyler, thanks for joining me, and thank you all for joining us on Street Trek. And we will be back. Enjoy the long holiday weekend, and we'll be back next Friday.